Well, hey, for all those listening, I have the pleasure of having a great friend of mine, Mr. Paul Meeks, very well known in the investment community. He's also a good friend of mine. He loves good classic rock and roll, which is always a plus for me. But Paul, gosh, how long you been a portfolio manager, Paul? About 32, 33 years?
Yeah, I started in 1987.
Oh, gee, who can remember that famous year, right? That's a great time to break into the business.
Yeah, yeah.
So, for those listening, I'm going to put this on the Denny Artachi podcast. Paul's on CNBC most every week. He talks about. He's very well known for technology fund. He ran the largest technology fund for Merrill Lynch at that time. But Paul's been with Independent Solutions since 2018, I believe, right, Paul?
That's right.
And you have a technology fund, but you have a dividend model. There's so much I want to talk and have my listeners listen in and chime in. First, let's do the crystal ball questions. You ready? Because
Yeah.
you know everything, like where the market's going from here. That's the first thing that people want to know, right?
Yeah. So, I mean, the way I look at it is I believe that we're either in a recession or one is imminent, pretty quick in 2023. But, that's not new news. So I actually think that, we're going to have some scary times between now and maybe the next couple of meetings of the Fed, which is really the driver of all this thing, how quickly they raise interest rates. But I would say that if you get to December 31st of 2023, I bet stocks are up next year. Now, obviously, this year they're going to be down. Right now, year to date, the S&P is down 20 something, and the average tech stock is down 30 something. But I think market could go more. The rally that we saw in October, which was pretty strong, could be a bear market rally. I don't dispute that. But I think next year, even if the goodies are stuffed in the back half of next year, I think 2023 stocks will be up. And that means we have a recession, though it's going to be short-lived and rather shallow. And so that's why I have the confidence that we see through that. And as investors, we invest 6 to 9 months out. So I'm feeling pretty good about stocks being up in 2023 once we get to the end of the year. Could start out a little nasty, but I think once we get to the end of the year, it'll be nice relief. That means a pretty explosive rally in the back half.
Well, it's interesting because you mentioned something, and it's true. The market always trades for the future, not what's happening now. The Fed just raised rates again. They
Yep.
anticipated this. Corporate profits have not been where they need to be. Why? People are spending less money. When you see the fact that just a year to year and a half ago, you could still mortgage a house and pay in the fours. Now it's 8%.
Yeah.
And people, that's going to stop. It's going to stifle the housing market. But Paul, I'm not a conspiracy theorist. The world's been coming to an end for the last 2,000 years. I don't think that's happening now. Interestingly enough, because you and I are friends and we've done many of these little chit chats, you foresaw some softness about a year ago around Thanksgiving time, didn't you?
Yeah, particularly in the tech sector. Now, the tech sector had such a marvelous run, huge gains over multi-years. Tech stocks are really big beneficiaries of essentially a zero interest rate environment because their cash flows are so far out into the future. So they got like a market on steroids. However, you could see that not only the stocks were overvalued come Thanksgiving last, which is about a year ago now, but also that there might be some signs of economic slowdown. And some people think that technology stocks can grow through anything. Maybe some companies do if they have a special product, but most of them are pretty cyclical and they go the way of the economy. And so also for technology, some of the demand was pulled forward during COVID, right? You had some companies that were huge beneficiaries of the move to remote work. And of course, that actually, catapulted them. And so, yeah, I was pretty worried about tech. And frankly, even though some tech stocks have come down a lot, I'm not all back in yet. And that's even a year later.
Well, it's interesting because think about it. Bonds have become attractive now for the first time in what, 10 years that you can
or
think
more.
of? Because rates were held artificially low. They were afraid to
Right.
stifle the economy. But my God, Paul, I think you told me just last week that you're finding municipals yielding around 5% on 5-year paper.
Yeah.
If you would have said that a year ago, they probably would have asked you to take a drug test, right?
Right. Yeah, it's good that you mentioned that because the last time bonds were attractive, I think it goes much deeper past 10 years. And yes, now you can buy municipal bonds, which most people don't realize. But here's the reason that you play municipal bonds is that the income that you receive from the bond is exempt from federal taxes. And in some states, it's also exempt from state taxes. Of course, you don't have to worry so much about that in the state of Florida. But yes, for people that actually have wealth, and so they have a pretty big tax bite, that 5% municipal bond on a tax equivalent yield basis probably yields 7, 8, 8.5. And so we haven't seen that in a long time. And these are high quality bonds too. They're rated by S&P, Moody's, single A, double A, and so very little risk of default.
And real money is paying attention to bond rates right now. It's not just munis. Corporate bonds are also paying good dividend yields, and you don't have to go that far out to get a yield. You know that it's really changed a lot when you see insurance companies offering fixed rate accounts. I can't believe it. I recently saw in Florida, they're not available in every state, but a 2-year fixed rate paying 4.25%, Paul.
Wow, that's very attractive. Yeah.
So for those that want to park it on the sidelines, now I don't want our listeners to take this the wrong way, because you shouldn't put all your eggs in one basket. One thing I love about you, you're known for technology, but you have a dividend model. You yourself see the value of diversifying, not just in different industries, but also parking some of your money if you can get a safe return on your investments.
Yeah.
Are you still doing that with your dividend model?
Yeah, and the nice thing about the dividend model is as recently as 6, 9 months ago, I was screening for stocks that had at least a 2% dividend yield, because in a low interest rate environment, that was pretty heroic. And that
Right.
was a yield that was even higher than that on the S&P 500 index. However, now that interest rates have risen, dividend yields have risen some. Some companies are paying out more of their income in dividends. They have to if they want to compete with bonds. And so now I run the same screen, Denny, but I run for 3% plus. So you get 3% plus dividend yield. And of course, the reason that you're still investing in stocks rather than bonds, apart from the yield, is you get the price appreciation too. So yeah, I'm pretty comfortable. And the nice thing about the dividend portfolio is a natural hedge against tech, because tech companies are rarely included in dividend portfolio, because tech companies dump all their money back into R&D. And so where do you have a concentration in a dividend portfolio? It's in energy, because the oil patch always pays pretty big dividends. It's utilities, and it's consumer staples. And those three sectors have done pretty well this year because they're naturally defensive, particularly consumer staples. And of course, energy, with the problems exacerbated by the war in the Ukraine, price of a barrel of oil, even though it's come down from the top the last few months, is still up about a double from a year ago. And so energy has been a great sector. So you get some defensiveness. It's where the money has flowed in these troubled times in 2022. And now you're getting a 3% dividend yield, where just a couple of months ago, you couldn't find any of those on a screen. Now you can, because it used to be, boy, we used to settle for 1% and 2%. Now it's 3%. So that's good.
I guess the interesting thing is to see how long this lasts, because I don't think inflation is going to continue spiking uncontrollably and rear its ugly head. I do see that it's somewhat stabilized. I don't see that it's spiked up in the last 2 to 3 months. We would like it lower, obviously. This is why the Fed has done what it's done. And yes, the recession, the monetary policy definitely doesn't help recessionary fears. We're not technically in one yet. They refuse to admit that we're in a recession because the thing is, this is a global issue, inflation. It's not just something that America, and actually, I read statistics that the dollar is actually pretty strong right now.
Yeah.
So that's good for us. But if you look at other countries, they have 10, 15% inflation. We're somewhere in the eights.
Yeah.
So it's very possible, Paul, that we could see it going the opposite way next year, isn't it?
Yeah. Yeah. So we've had four hikes of 0.75% in each of the last four Fed meetings. They next meet on December 12, 13. I think they're going to continue to raise rates at least for several meetings into 2023, but I think they're going to taper it. And the next meeting will be a 0.5% increase after 4.75% increases. So you'll see a tapering the rates. And I do think that the aggressive rates that they have promoted in the last year, will start to show an impact on lowering inflation. You're right. We've been hovering around 8. It's been very stubborn because each month it comes down a tad, but only a tad, and we like it to come
Exactly.
down more. But one of the things that you mentioned at the top, Denny, is a really good point. If the home market cools, because interest rates are now
And
very
it has,
high.
Paul. I think new home sales are down about 20% this year, and new construction is down about 10. One of the things, obviously, because it's a big difference between paying 8%
Oh,
and
yeah.
4% to finance a home.
It's huge. And you think about it, the calculation that most people use to follow inflation is the consumer price index, the CPI.
Yes.
About 40% of the weight of that math is housing. It's not just mortgage payments, but also apartment rentals. And so if you actually see those numbers start to come down, some relief when the housing market turns over, then that will have a big impact on lowering inflation, right? Because that's 40% of the calculation right there. So with a lag effect, these interest rates, which have been painful in the near term, will probably start to cool inflation, not rapidly, but more modestly. And I think we'll start to see some nice improvement as we get into the first and second quarter of next year. And then once we see inflation and interest rates at least stabilize, that, in my view, triggers a nice rally in stocks and all financial assets in the second half of next year.
It's interesting how a lot of these things affect behavior, which affects spending. I never could see the logic behind it's good for the economy that families are spending frivolously and building up their debt load.
Yeah.
But that's the world we live in. Do you see a particular sector that maybe could benefit from what's been going on going into the next year?
Yeah, I think that financials should do pretty well because the financials, at least the what I call the plain vanilla banks, that all they do is borrow and lend. They're not involved in trading yen futures or doing IPOs. So not the money center banks in New York, but the local and regional banks that are in plain vanilla lending. They will have a nice increase in their spread, right? The spread between what they pay on deposits and what they receive in loans. They call that for a bank the NIM, the net interest margin. That widens in a higher rate environment. And as long as the economy doesn't spin into a recession, because if it does, then you worry about some of these loans that they're extending not being paid. I don't think that's going to happen. But the financials could be in pretty good shape. For example, I've been buying fairly aggressively Wells Fargo and Bank of America because they fit that profile versus the Wall Street titans like a Morgan Stanley or Goldman Sachs that don't get enough pop from borrowing and lending because they're in all those Wall Street gigs. And so, yeah, there are some banks that have high yields, and you're going to get some nice price appreciation in the next cycle. So I think it'll be a nice double whammy.
There is one more elephant in the room, and I really, I do not like politics. I don't like to get into it. I don't like to discuss it because people are emotionally charged. And my take on it is both sides have their issues that need fixing. But we're looking at the midterms tomorrow. That could
Yeah.
have a big impact on the market. On if the Republicans tend to flip the House and possibly the Senate, we will probably see gridlock, which the market actually likes gridlock, doesn't
Yeah. Yeah.
it?
That's a very good point, Denny. I've taken a look at this over, the history of the Republic, and a lot of people stress out about Democrats and Republicans, who controls the House, who controls
Right.
the Senate, who controls the White House, and even what is the mix of conservative and liberals on the U.S. Supreme Court. But over time, the evidence shows that there's not that much of a difference to the stock market. I know people get caught up in it, but it's not that much of a difference. So what I think happens, I think the GOP takes the House. I think that's probably a foregone conclusion, as you're right, Denny.
Probably, yeah.
They may take the Senate. That'll be more of a squeaker. But I don't think that anything changes that much. I think what will happen is the Republicans, once they're in office and they have more control, will push back on the debt ceiling. Well, we're coming up to another major, like we always do, unfortunately, where if the government doesn't raise the debt ceiling, they can't pay their bills, and then they got to shut down the government. Right? We do this.
Drama queens.
I think that'll come because the GOP will want to make a stand on that issue, if nothing else. But besides that, which I don't want to say is a minor issue, but that happens, quite often. I think that we're in a pretty good place. And you're right. When there is gridlock, what I like about gridlock, no new taxes. Right? Remember, Biden came in to office with one of the most important and highest items on his agenda was to raise taxes.
And
after Trump had lowered them. And it hasn't happened because here comes Ukraine, here comes COVID, and it moved the tax all the way down the agenda. And that was a perfect example of something that people were really worried about. Never happened. Now it's like item 17 on the agenda. They won't get to it. And when the Republicans come in, it goes from 17 to 70. Not happening. So I guess that's probably a good thing.
Right. And look, like you've told me many times, the Fed really dictates market conditions more than any particular administration. It's just the perception people have. And you and I both try and tell our clients not to get emotional about these things. And so I still believe, as you probably do, long term, if you're investing for, say, the next 5 to 10 years, there's probably some pretty good deals to be had now and going into next year.
Yeah.
Isn't that true, Paul?
Oh, I think you don't have to even wait 5 years. I actually, feel that we'll have this rally next year. So late next year, you think about it, today's November 7th, feeling pretty good about November 7th of 2023.
Wow. Unless,
so,
of course,
there's some stocks that are down a hell of a lot. Now, there's always stocks that when we have a market correction, they're exposed, right? Those that are exposed for flawed business models don't come back. But yeah, there are going to be some good opportunities, and not just in stocks, but Denny, just like you were talking about just now, in some bonds too.
Which sector do you think is really going to be affected or hurt the most, or has been hurt the most? I'm sure technology is not the greatest either, but
tech has been badly hurt. Recently, utility stocks have been hit because as interest rates rise, utility stocks and real estate investment trusts are very interest rate sensitive.
Okay.
And so, typically utilities are fairly defensive. They had been defensive for most of this year. They've been whacked in the last month. Real estate investment trusts, the same thing goes. Technology has been smoked, right? The S&P is down about 20%. There are some marquee tech stocks, a la something like Meta, the old Facebook, that are down 60 to 70% this year.
Wow.
And that's not a fly by night. That's a, marquee company. It used to rule the world. So what I'm trying to do is go through the tech portfolio, because there'll be some that you never want to come back to. They've been exposed. And there'll be some that are still good long-term plays that you say, wow, that's a pretty good discount. And so, yeah, I'm going through all that analysis as we speak.
And you still, again, I know that in the last 6 to 9 months, you have been taking money out of some of these positions, going into cash and going into the dividend models.
Yeah.
And you also work with Peter on the momentum fund as well. Why don't you talk about that a little bit? Because I find it really interesting how you do that.
Yeah. So when you hear momentum model, think about technical analysis, which has nothing to do with technology. Technical analysis means you're reading the charts.
Okay.
You're reading the price charts, and you believe if something is working, it's going to continue to work, and if something is not working, it's going to continue to fail. I like to call it, because I didn't coin this term, but on Wall Street we have a term called the cockroach theory. Now you live down in Florida. I live in South Carolina, where the
When you say
roaches are not
cockroach,
small.
I think of Tony Montana. I'm sorry.
There you go. But like in where I live in South Carolina, it's a big roach, and we call it a palmetto bug. But you know what? It's a cockroach. So you want to get a drink in the middle of the night, you go down to your kitchen, you flip on the light, you see one roach, scurrying across the floor. When you see one, do you think there are more?
Yes.
Of course you do. And so that's what the cockroach theory means, and it's all about momentum. If things are going well, there's not just one roach. There'll be more good tidings. If things are going badly, there's not just one roach. More bad stuff will happen. So
Well,
that's just how you play it. And right now, the momentum, no surprise, because things have been so bad this year. The momentum model has an extraordinarily high proportion of cash because other stuff hasn't been working. And it hasn't given us the signals yet to go back into stocks and bonds in a big way. But when it will, then we'll have even more confidence that we're back. But right now, the cockroach theory says be heavy cash in a momentum model.
Isn't it also that you're basically following a trend? If you and I raced, 5 times in a row, and I beat you 5 times in a row, what are the odds that I'm going to continue to beat you?
Yeah.
So I think the way Peter was explaining it to me, you watch the momentum on a monthly basis, right? And you see that the price continues to appreciate or it does not.
Right.
So, God, it's almost like what people would love to it's the hindsight theory looking at things, but
Yeah.
but
It
you
may not
really
be
are
bad to have a portion of your portfolio in such a strategy, because during tough times it gets you out,
right. It's
and
the
it gets you
discipline of
out, and it's disciplined. It's all algorithmic. There's no emotions involved, and you're not going to make a lot of money with 100% cash portfolio, but 100% cash portfolio for a good chunk of this year, boy, sure beat the hell out of the S&P 500 down 20 and the average bond down about 15%.
right. Well, the other thing that's the thing that I notice about the momentum portfolio, that instead of being down 20%, it may be down 7 to 8% because
Yeah,
it did not get emotional. It technically said, once we see these triggers hit, we're out. We're
yeah,
not going to think about it. We're not going to get emotional or sentimental.
yeah.
So that's how people should approach a lot of investing, or they should find someone like you. I I stopped trading, I think, in the 90s. I let you professionals handle
Hmm.
it. I'm more of a behavior specialist. Clients come to
Unfortunately,
me.
the crystal ball is a little bit hazy for everyone.
I'm sure it is, Paul. I mean, geez, what do you do in this market? You have to invest for the long haul. But I think what it is people got so spoiled with this great bear market that we had. I think their sense of reality is a little bit far-fetched now, kind of
Yeah,
like in 2020 when we had the correction because of COVID and it snapped back a few months later. And people thought, oh, that's how it. No, no, that's not how it normally is. When
yeah,
you see corrections, it could take a year or two to come back. And I think obviously because rates were so low for so long, you had to invest in something. But then again, I know a lot of people that are sitting in cash, not just smart money managers like you, because they want to see how things shake out in the economy. They want to see if this is truly We don't they haven't officially admitted that we are in a recession, but did we have 2 quarters of negative growth?
Yeah, the first and second quarter of 2022 were negative growth, so that's at least one definition.
Okay.
But then the third quarter, right, the quarter ended September 30, the economy grew over 2%. So I guess on again, off again. We'll see what happens. One of the things I've noticed in this round of quarterly reports, because I listened to all these conference calls, is the rates are starting to hit some of these companies with a lag, right? Because they've been raising rates since March. Maybe you didn't have the immediate impact, but now you're going to have, unfortunately, the nastiness with a lag. And I see that a number of companies, particularly in the tech sector, are laying off people in pretty big size. Your buddy Elon Musk announced last week that he laid off 50% of Twitter, right? He buys
Really?
Twitter and he fired immediately 3,000 to 4,000 people out of a workforce of about 8,000.
Wow.
So that's a big job cut right there. And so, yes, we're going to have, which we haven't seen in a long time, some softness in the job market. And I know it's bad if you lose your job, but on the other hand, it shows you some slack in the economy, which actually will allow us to soften inflation and stop the incessant hike in rates. But yeah, it's a matter of time. I actually think once these job cuts filter through the system, that yes, we will have a recession. It'll be officially declared, sometime fairly early next year. But at that point, you're saying, who cares? Because I'm investing for 9 months after that.
Right. And how long will the recession stay?
Right.
And also, it's interesting, the job market, because it's technically good, but wages have not gone up to battle inflation. That's an interesting.
Yeah, wages are on the rise, but not as much as inflation, when inflation is, running at 8%, as you said.
And that's the technical. When I still go shopping and I see that the carton of eggs is double of what it was a year ago, that's not just 8%.
Yeah, you're kind of wondering, how do they do that math?
I don't know. Exactly. They base it on real estate. And I do believe that real estate is going to continue to be soft until we see rates go down. I don't see a crash. I don't think we're going to see what we saw in 2008, because that was just sheer greed and stupidity. But it will affect things, and I think people are spending less, which will affect corporate profits. But at the end of the day, I do a lot of social media marketing, as you know. I keep telling people to take advantage of rates, because you can get some fixed accounts and some bonds and things that are attractive. So at least you're making something on your money instead of just sitting in cash.
Right.
I never thought that inflation and higher rates could be a good thing, but if you're squeamish about the market and you can't stomach the ebbs and flows, certainly there are some attractive yields out there. Certainly, and it's
I like the fixed idea. The thing with bonds is that while interest rates are still rising, the bond prices will fall because they move in opposite directions. So while we're getting higher yields on bonds, they still have some price risk until the Fed finally raises the rate the last time and holds it there.
Right.
But in the meantime, a fix, as you said, 2-year paper at 4%, that's extraordinary.
I never, right. It's something I haven't seen in a very long time. And so, but the other thing could be true as well. If you're buying, say, 5-year bonds and the rate hikes stop next year, you could see capital appreciation.
Yeah, because what will happen is if I'm wrong and the recession is not short and shallow, but longer and deeper, then the Fed will be forced to turn around, start lowering rates to support the economy. Then you've locked in your high fixed coupon rate, plus you get the price appreciation. So I am not worried about interest rate hikes 5 years from now. I'm only worried about them in the next year. So again, once rates plateau, bonds also become maybe even better than stocks in a price appreciation perspective.
Always a pleasure. I'm looking forward to our conference that we have every year in beautiful Jupiter in April. Last parting shots. Always got to ask someone like you, your favorite 1 or 2 stocks going forward that you're kind of
Yeah.
You're sweet
Yeah,
on it.
there's a tech stock that I like called Harmonic. Ticker symbol is HLIT. They support. It's a communications equipment company that supports cable and these per TV guys, the video streamers. Company has done very well. So it's a smaller company. It's not one of the FANGs. It's not one of the mega tech companies, but I see more value these days. And yeah, take a look at Harmonic, ticker symbol HLIT.
All right, I'm mortgaging my house and I'm putting it all on black.
There you go.
Paul, always a pleasure. You're a great friend, and my God, when you speak, I listen. I didn't even tell everybody all your credibility and everything you do. You're still teaching at the Citadel in Charleston, aren't
Yeah,
you?
I'm teaching at the Citadel. I teach finance and accounting.
Man. So let's talk in your spare time, okay?
Okay, yeah,
Be
that's
well.
my
Paul
problem.
Meeks, ladies and gentlemen. Thanks again, Paul. Have a good one.
All right, see you later, everybody. Bye.